So I've got a question for you. Are you betting or are you Betfair trading? And actually, is there any difference between the two of them? Why would one be any different from the other? Is there some fundamental underlying characteristic that defines the two? And after all, when you're trading, you're placing bets anyway. So aren't you just gambling? Is there much difference between the two? Well, yes, there is. And I realize that's easy to say on social media because, all of a sudden opinions become facts on social media for some reason, and people who have no knowledge, experience or track record become experts. But obviously, I have a long background in this. I originally started football betting, went into financial markets, and then when betting exchanges came along, I started to actively trade on them. And that was because I'd seen trading on financial markets and spread betting in particular. I figured out that what we were looking at with betting exchanges was a stock market for sports effectively, and you could trade it exactly the same way. And that is pretty much what I've been doing all this time. Now, I do bet as well, but there's a very clear line between them. They're done on separate accounts and they're managed completely differently because you cannot merge the two together. Your objective when betting and your objective when trading are radically different. So what I'm going to do in this video is give you an analogy that will allow you to understand specifically whether the strategy you've got is betting or trading, or perhaps it's merging and blurring the boundaries between the two. But I will give you an analogy that will give you a clear definition of exactly what you're trying to do. So I think, when you look at all of the individual aspects of it, I think especially if you're new to this game, it's very simple to misunderstand exactly what your objective is when trading. But the best way to describe what your objective is to use a coin flip. And if we flip a coin, we can actually translate that into something that you would see within a betting market. So on the betting market that we're looking at here, which is the coin flip betting market, you can have a heads or a tails. And when you flip that coin, it's going to land on heads or tails. Let us say we put £100 down on heads. It turns over and it ends up on heads. We will double our money. But if it ends up on tails, we will lose our money. And the only thing that will define if we make a profit over the very long term in this particular betting market is if we can guess heads or tails more frequently than actually occurs. So what we're effectively talking about there is a pricing error. The market is mispriced. There's something that we know that the market doesn't know that is going to deliver our long-term profit. But also, when you put that stake into the market, you put that stake down, you wait to see what happens within that market, and that defines whether you made money or not and how much money you have left to bet on the next market. That is essentially what we're doing when we're betting, and particularly when we're value betting, is we say that we know that this is going to occur more frequently than the odds suggest. So say we're looking at a football team at odds of 2, that would translate to a 50% chance in implied probability. And if we can actually back them at odds that are much, much greater than that, then we have a theoretical edge, and that edge will play out over a long period of time. Put that stake in that market, we look for this edge repeatedly, and over a long period of time, if we're correct, we will make a profit on that. So when you're looking at traditional betting, that's what you're trying to do. You're looking for the market mispricing. You're using a stake, you're waiting for the outcome, and then you move forward from there. But when you're trading, you're doing something completely different. First of all, the strike rate will be defined by the underlying strategy that you're using. So if you go into a horse racing market and you offset by 1 tick, that will have a defined strike rate. If you're offset by 10, that will have a defined strike rate. If you're trading football and you pursue a certain strategy, that will have a defined strike rate. Your profit will come from being able to exceed that, but it also comes from a number of other factors as well. So if we go to the coin toss, what we're actually looking at here is when we're trading, when you flip that coin, you're not trading the outcome of the actual event itself. You're trading, the heads, the tails, as it spins through the air. It's turning through the air and then eventually lands on one or the other. By then, you're out of the market. Your trading position was opened over here. You close it before that coin hits the desk or spins onto the table, or however you chose to make that coin toss. But basically, when you're trading, you could effectively trade that period in between, that moment of indecision, the uncertainty within the market. That's the essence of trading. And that's where most of the money is made in trading, is the difference of opinion between people backing and laying at different prices at different times over the course of the event that you're actively trading. So let us say, for example, we want to actively trade this market. We can actually flip the coin, and if we put £100 in that market, then we could lay heads with £10, and when it turned to tails, then we can actually sell that bet back into the market, and then it turned again, and then we repeat that trade. So you can actually do that trade many times from when you actually open to when the market closes, and you can actually put that stake through the market repeatedly. But the important thing to note when you're trading is your stake is not at risk. A small proportion of it may be, based upon the movement that you're expecting to see and over which particular time period. But that stake should never be at risk when you're actively trading. You put the money into the market, you take the money out of the market, and then you repeat that process as many times as you see fit within that particular market. So betting is reliant upon the outcome of the event. You tend to do it just once, but also your stake will be different from when you're actively trading, because when you trade, you'll tend to use larger stakes because you can only ever return a percentage of that in profit. But you shouldn't worry about that, and it does freak people out. People go in to trade and they put £200 down and they go, oh! Because it feels like they're backing or laying something for 200. But in essence, you shouldn't, because you're effectively putting it in and then you're taking it out. And your risk is partially defined by how long you have that position within the market. But essentially, betting is outcome dependent, but trading is that period between the start of when you decide to trade and the known outcome of that particular event. That's what you're actively trading. That is where you make your money when you're actively trading. So if I trade a golf tournament, for example, this is a good example of this because golf tournaments can last for days, then I will actually go into the tournament with a fixed stake. I will actively trade something, and then I'll do it again and again and again and again and again and again, because it lasts for so long. So if we look, for example, at football, there are many ways that you can actively trade football, but again, bearing in mind those characteristics, let's say that we lay the home team at 80 minutes, expecting a goal to occur. Is that betting or is that trading? Well, essentially, if you go in and you lay that home team at 80 minutes, what you're saying is that there's a mispricing within the market, that the price available at 80 minutes is incorrect. You think that you've got an edge there, and that edge is reliant somewhat perhaps on a goal going in or not. But essentially, that is a value bet. And okay, it includes an element of potential trading there, but it's much more heavily skewed towards being outcome dependent rather than outcome independent. You've got a limited time to do it, and you're probably not repeating the trade. So you'd sort of move that over more towards the betting side because it's reliant upon price, probably only going to use one particular level of stake, and it is, somewhat outcome dependent. But if you trade on horse racing, you have this beautiful period before the start of the race where it's driven by purely opinion and emotion. So, if somebody thinks that they don't like the horse, they'll lay it and the price starts to drift. And you're actually in and out of the market over that defined period. You'll probably use a larger stake because it's not going to move 100%. It's only going to move, maybe 10, 15% over the course of 20 minutes or so. So you are actually making a trading judgment. And when you close your trade, then it becomes outcome independent. But also, maybe you're not going for a large move. Maybe, the market's pretty dull and uninteresting. Well, you could actually trade on a narrow band at the current price, and you could just put that trade through many, many times. And you open the trade, you close the trade, you open it, you close it. But you don't sort of open thousands of trade or vary your staking. You stick with the same stake, and then you just repeat that stake many times. That reduces your ability, well, I was going to say reduces your ability to get a loss. That's the wrong word to use, but can you see what I'm trying to say here? Because you're using a fixed stake and you're trading in and out repeatedly on that, you should never have that full stake at risk at any point within the market. So there are actually clearly defined differences between betting and trading. I bet and I do trade. I didn't do any value betting in the early days because the market was so efficient. I didn't think that I would be able to find an edge, but lo and behold, over time I have been able to find an edge, and I have been able to define moments within the market where value does appear, and necessarily I will take that. But predominantly most of the stuff that I do is trading. That's where most of the volume is created and most of the profit. And necessarily, you see the equity curve on that being nice and smooth. But if you look at the equity curve on a value betting strategy, it's all over the shop, but generally ends up over a period of time. So yeah, there's a clear definition between betting and trading. Some Betfair trading strategies are sort of dressed up as really quite elaborate betting strategies, because they end up becoming outcome dependent. They tend to use a fixed stake, or they tend to have quite large liabilities with them that could wipe out a lot of the previous trades. But essentially there is quite a large definition or a line between the two of them. Some of them can sort of get close to merging, but hopefully by giving you this definition of what is a bet, what is a trade, you'll be able to decide more effectively what strategy you're pursuing, why you're pursuing it, and really what your true objective is with that. In terms of preference, my preference always is to trade. I do the value betting stuff for a number of reasons, but part of it is just because I can. Some of it is it helps generate a bit of commission. But essentially the trading side of things I think is much more effective because you're not taking any of that last minute risk. You don't need to worry about it being heads or tails. You can profit whether you know what's going to happen, whether you don't know what's going to happen. There are so many ways that you can trade very effectively within the market. But yeah, hopefully I've drawn those lines a bit firmer for you, give you a definition of exactly what betting is, what Betfair trading is, and allow you to understand the level of risk that you're taking with each of them. But hopefully you've learned a little bit within that video as well, in terms of exactly what your objective should be when you're actively trading. Anyhow, I hope that video has been useful for you.